In today's video, we're going to dive into the world of bull call spreads, and we're going to talk about how they can help you capitalize on a bullish market. So let's get started here. First things first, what exactly is a bull call spread? It's an options trading strategy. It allows you to benefit from a stock's limited increase in price. By combining two call options with different strike prices, you can limit your losses, but at the same time, you cap the gains that you can make. Now, one big advantage of a bull call spread is that it is better than buying an individual call option generally. Plus, it limits your max loss to just the net cost of the strategy. So talk about risk management. That's really good. But, there's things to consider. Any gains above the strike price of that sold call option, well, essentially they're forfeited because that contract could be exercised. Your gains are limited due to the net cost of the premiums. So a moderately bullish outlook. Now, moderately is important. That's the key for this strategy to work. So how do we start this? Okay, well, you got to analyze the market, identify a moderately bullish trend in the underlying stock. And we can even say it's gradually rising. We just don't want to see huge momentum. Next, you got to select the strike prices for your long and short call options. The long call should have a strike price below the current market price. This is the call option you're going to buy. The short call should have a higher strike price, and this is the option you will sell and receive premium on. Talking about premiums, you have to evaluate these in the call option because this is going to help you determine the net cost of the strategy for you. That premium that you get from selling the short call should offset the premium that you pay for buying the long call. So let's talk about the stock price and volatility changes and how that can impact it. So when that stock price rises, the price of your spread is also going to rise. If the stock price falls, the price of your spread will decline. Now, changes in volatility, they do have minimal effect on the pricing of the spread. So let's talk about expiration. What happens? Well, it depends on the stock price's relation to the strike prices. If that stock price is at or below the strike price of the long call, both of them expire worthless and you get that max loss. If the stock price is between the strike prices, the long call is exercised. Could be. Your profit or loss depends on the stock's price relative to the break-even point. And if the stock price is above the strike price of the short call, both options are exercised and you have a long stock position with a capped profit. There are some drawbacks to it, but in conclusion, bull call spreads, they're pretty valuable. You should consider them in a bullish market. They do offer limited gains. They do help you manage risk. When you strategically combine call options, you can actually navigate periods of high volatility and make better choices in your trading. So it doesn't matter whether you're experienced or just starting out, bull call spreads can be pretty powerful in your arsenal of tools that you're going to use. But remember, you got to watch those market conditions. You got to watch the strike prices and the premiums to optimize your risk management and the potential profit. If you found this helpful, subscribe to our channel, give us a like, and we'll talk to you soon.